Hi, welcome to the Market Alert for Thursday, the 21st of May. So, foolish to rule out negative rates, says Andrew Bailey, the Bank of England governor. Let's have a look at this in a bit more detail. I mean, let's face it, there's no surprise for anybody who's watched the Market Alert for the last 10 years or more. Andrew Bailey says the bank is looking very carefully at the experience of other countries which have used the policy. Well, let's start with Japan, Germany. It's a disaster. You end up with stagflation. You never recover, and it is not a policy that is going to work. It's as simple as that. Hopefully they won't do it, but I'll guarantee you that they will. As he says down here, Bank of England Governor Andrew Bailey has refused to rule out cutting interest rates below zero in response to the coronavirus economic crisis. You see, they dropped rates just before we went into this crisis, or in the start of the crisis, and it didn't make any difference. And sending them below zero isn't going to make any difference either. The bank has already slashed rates to record low 0.1 as the pandemic drags Britain into what is expected to be the worst recession in living memory. As I say, it's semantics here, and also completely wrong. It's depression, the greatest depression is what it should say there. Mr. Bailey told MPs it was now studying how effective that cut has been. Well, I can tell you how effective it's been. It hasn't. It's as simple as that. You have to look at the jobless claims. As Einstein said, the sign of madness is doing the same thing, expecting a completely different outcome. And this is precisely what the central banks are doing. On the prospect of negative rates, he said, we do not rule things out as a matter of principle. No, because you're going to be forced to go into negative rates. That's why. That would be foolish. I think it was Abe Jacobson that said, don't believe anything until it's officially denied. As prior to all of this, Andrew Bailey was saying we don't need to go negative on rates. So as soon as they say it, they're going to do this. But that doesn't mean we rule things in either. So there's the Abe Jacobson piece in this article. That means that they are going to go negative on rates. And also yesterday, for the first time in British history, as you will see here, it says Britain's borrowing costs turn negative with huge implications for government policy. The UK has sold 3-year government bonds with a negative yield, meaning investors are paying for the right to lend it. So let's just clarify something here. What we were just looking at was the bank base rate. This is the yield or interest that's paid on gilts, and this has turned negative as of yesterday. It has been commonplace for a while now in countries like Germany and Switzerland, but today the UK was able to join the enviable ranks, I wouldn't call it enviable personally, of those countries which are effectively able to charge investors for the right to lend to them. Whereas prior to yesterday, on these 3 year gilts, you would have effectively, even if it was 0.1%, you would loan your or buy these gilts off the government and effectively be paid interest rate on them. Now you actually lose money by actually holding them. An auction of UK government IOUs, Gilt saw the Debt Management Office, the Treasury agency that handles the government's cash and debt management, sell 3.8 billion worth of 3-year bonds with a yield of minus 0.003%. 3.8 billion isn't a lot. I'm just wondering whether this is a test case to see if there's any appetite by any investors to actually help the government and lose money into the bargain. We'll see going forward, but as it says here, that means anyone buying bonds at issue and holding them until maturity will lose money. That's a great deal, that is. So this is where we've got to now. We're not only printing like it's gone out of fashion, but we're also now heading into negative base rates, and also on the money that is actually printed as well. So you've got to hope that somebody will have that sort of charitable mind and spirit and say, well, I'm going to help the government out and I'll pay for it as well. Incredible. Absolutely incredible. Where does it end? Well, it ends badly. We all know this. And that's unfortunately the way it is going to be, which is why you're seeing the precious metals moving strongly to the upside, because that's the only thing that has any value left in it as far as the monetary system is concerned. And you're seeing a flight into the precious metals arena, which is what we discussed yesterday. And even the central banks knew this in 2010 and started accumulating the precious metals, because ultimately, as the system falls apart, the confidence evaporates, and the more the confidence evaporates, the more the system falls, and eventually there has to be some sort of either debt jubilee, some reset or whatever, because you will never ever recover from this. We haven't recovered in the last 12 years from the 2008 crisis, so to do more of the same at 10 times the amount and continue to reduce interest rates and then issue gilts that are negative as well, anybody with half a brain cell can see that this is not going to work. So let's have a look at the markets, and of course this is a complete disconnect from what's really going on as far as the treasuries are concerned globally, and also the economy. So yesterday we see the market move higher, but it's not moving at any great knots to the upside. This market is treading water, and it's starting to look quite weak as well. You can see a bit of a sideways move there, dip down to the 50 bar moving average in the low over here. And I suppose really we could do this if we wished to. You could draw it like that, but this market is range bound, and it's just a matter of time before, if there's any sign of the Fed having taking the foot off the printing pedal for a moment or two, you will see prices move to the downside and retest these sorts of levels. And in the intraday for yesterday, well, while we're here, let's have a look at the overnight. As we drag the chart over, we can see that prices have been down overnight as they came on stream, closing below the 200 MA and trading down to the DP level, then breaking through down to yesterday's DP level. So a bit of weakness around on the overnight, but yesterday, let's go back to the pre-market session, because again, using derivatives, the Fed can quite easily bring the Dow up in the pre-market session. When we get into the cash market at 2:30 and those that have sell orders start selling, the market then likely to move lower. But again, you see that same pattern constantly in the charts here. So here's the open yesterday, and Andrew Bailey was speaking. So the first hour was taken up with the Bank of England chairman, as he was talking about his negative rates, or denying or accepting, or whatever he was, whatever rhetoric he was spewing out with regards to. We know where they're going. They don't need to actually tell us. So anyway, the market managed to move higher thereafter, up 100 points, and then you've got the classic down back 78, 76%, and then we made our way down to the 200 bar moving average. We had the FOMC meeting minutes yesterday evening, and you can see this here. We've got a couple of spikes up and down. The market retests at the 200 MA, and then it's back up before the close, thanks to the plunge protection team erasing, coming back. You can see there 76% of the high to the low. I'll just measure that out just to show you, but again, just a glance, you can actually see this. There you go, bang on 78%. So that's the markets for yesterday. Like I say, the daily chart looks fairly weakish at the moment until the Fed can come out with another printing program. I think there's $3 trillion being negotiated at the moment in Congress, and we'll wait and see what happens. It's stalled a bit at the moment, and I wouldn't be at all surprised to see, it's Thursday today, that the Fed's balance sheet now is in excess of $7 trillion. And what have we got today? There's a German and French bank holiday today. We've got ours on Monday, and we've got the French and German flash PMIs. But again, the one that we are looking at is the unemployment claims, another 2.4 million. It's just staggering when you see the market doing this, and then you're seeing now this will take us close to 40 million job losses, and the stock market's going up. I mean, you can see the blatant manipulation of the market. So this is out at 1:30, and then we've got a couple of high impact news items. We've got the Flash manufacturing, which is going to be out, and for some unknown reason that's showing 39.3. Well, actually it would do because it's at a cost. And then we've got Powell speaking once more. As I said earlier in the week, he's out at 7:30 p.m. and again he's going to do whatever he can to try and bolster the market. So that's it for this one. Like I say, negative rates are coming because they've been denied. And well, they were denied, and now it's being lobbed into the press and into the media just so that you get used to the idea, and that Andrew Bailey is doing you a favour by taking rates negative because it's going to help secure your job, which is complete and utter crap, frankly. But we all know that anyway. Okay, that's it for this one. As ever, thanks for watching. See you in the next one.